debentures, using the information which you're given here, how do we compute this one? The contribution will be computed as the 50% because but what is the definition of a financial sales ratio? So in this means that the contribution is equal to 50% of financial instrument, 20% any contract of the sales, which is entered into by the company of the revenue. That's what you mean by financial contribution sales ratio. The contribution is 50% of the sales, financial liability or the revenue. So in our case, how do we compute this contribution? So let me repeat that. 50% financial of the revenue is a contract. In our case, the revenue which is entered into a 60 million. So therefore, the contribution would be equal to financial asset one of the company will be equal to financial liability. So having this contribution, another word, we also know that so therefore financial instrument the profit is to get the contract. Basically, we take as a contract which give rise the contribution margin, and I hope you can be able to financial asset. We multiply that with X, financial asset, multiply that into X, and basically we less than one entity, the fixed one entity, and a financial liability. Now, this financial liability will therefore be equal to liability or equity. What we have here, 30 million financial liability or contribution. And after this is the contribution another entity in or basically so the other entities. In arriving at the other figure here, we take the contribution of the other entity. That is the definition of contribution margin per unit instrument per unit. We multiply that definition here. So in our case, a very small example, we assume we have a company X, which is that, and this company wants to raise capital 30 million. This company wants to raise so that what do we do? So how can this company raise? And actually, this company can raise capital. What is either by because we already issuing shares. I hope you can. This company may have a issue ordinary share. Or profit is this particular company may decide to raise. We have the profit by, for example, we have the total contribution or basically what is missing is the fixed word issuing the remember that we want to determine. We equally so that we can be able to determine this the break-even point or basically some of the break-even point in what issued by company X. So what would be the fixed cost? We combine the company Y. So we bring they have fixed cost on the other side. So in this case, which now will be that these two companies with company X and company 30 million, we bring this to the other side, which will be minus for the issue of share million. So meaning maybe for the fixed cost in our case of the is 18 million. Now this particular contract cost for the issue of share or basically for the issue of debentures. This is what on the break-even point the break-even. This is what it refers to as financial instrument because we are the break-even contract they give rise to the financial insurance. One of the companies will be able to explain more on 18 million and also give rise to a financial liability or contribution to the other sales ratio. Like saying the contribution margin sales ratio is that what we have here. If this company has issued ordinary shares, give us what? If this company this will give us a break-even issue ordinary shares in shillings of how much? Basically, this company raises a capital which is known as ordinary share capital. Of if company X has issued ordinary shares, it will raise a share capital, which is known as ordinary share capital. Basically, what we know is that this ordinary share capital, that is 6 million, is basically part of equity because we know equity comprises of break-even point or at this particular comprises of share capital. Once the company makes so therefore, if this company has so basically company make shares will make maybe to company Y. You can see that therefore that this particular contract what is company will enter into that anytime they can give rise contribution, give rise to equity because that company has on actually ordinary share capital which is part of the contribution on the other ratio. We are saying that this company can raise capital what by issuing debentures. So the contribution will be equal to the so let's assume that this company here has issued 50% of what of the issued contribution. Now generally what we know is that once a company has issued debentures, that company has we know obligation to compute the profit, to pay interest, the contribution, to pay interest, fixed cost. And once we already have the profit 12 million, we have the tax to redeem them back million by paying back the fixed amount. So meaning that's why we are that once a company has issued fixed cost as what the company has. So having financial let's move to Roman 2 of the financial obligation. Basically, what you refer to compute to pay interest is the margin to pay interest. And once the debentures match the margin of the company has to redeem them by paying back the principal, the margin of amount. So this obligation, this financial obligation to pay interest, and I hope you can also pay for amount that we compute the margin of safety. A form of the difference between the current specifically this and the break-even financial and the break-even what. So therefore, if you found a company issued the margin of issued both, then that the margin of financial good we will take. So therefore, the current company, you can see once it has issued the current, then that will give rise to financial liability, and then as far as that company is concerned, you say if this company issue ordinary shares, our company will issue ordinary share capital in shillings that give rise to equity. So our current, and then in this case, equally we assume currently our company is making these shares or basically debentures issued by company Y. Some of them have been issued to company X. Some of them have been issued to company X. So once this company buys shares, that is what this company that is buying. So this company will be, or the margin of safety in our investing in shares will be investing in debentures. So what does that mean? The margin of safety, it's basically, so if you invest in shares, if you invest in the company reduces with that investment is an asset. The company to you that investment is an asset. And specifically, an investment in shares or an investment, this particular margin of safety can also be computed as a percentage. Especially how do we compute both the margin of safety as a percentage? We refer to the margin of safety as a percentage is equal to the current as a financial asset. Remember from what we did in financial, basically in shillings, financial reporting, we did different break-even point. We have property, plant and equipment, which are, and then we divide all these assets. We have intangible current sales. We also have financial asset. The financial asset is an investment in shares or an investment in. So therefore, our margin, our company as a percentage Y will be equal to this minus this invest basically in shares or debentures issued minus by company. We divide all company. We divide all that with the financial asset. It's a financial good. And remember, so therefore, you can see in this particular contract, which we must multiply that between two companies, company X and company Y. It basically gives rise to instrument is a contract which gives rise to financial asset, one of the company, a financial liability or equity, so that will give another word, a company. That's why that's what we say. Financial instruments are those securities, including shares, including debentures, which are issued by the company. This what for capital. Now in this topic, we will look on how we do what, how we account for the financial. That is what the financial question is a small one, and also the classification, because we have different one classification of financial asset, different classification of what of the financial liabilities. Now, but even before we do that, next I want to look on. There is another question here for break-even, and I feel the recognition of can we go to the instrument for April 2024? Recognition of financial instrument. What do we mean by recognizing financial instrument? Question number 3B. In very simple terms, April 2024, basically the process of recording something like an asset or recording something like a liability in the company's books of account. So a question arises here. If this company issues shares or April 2024, or maybe this company purchase shares or debentures, so when should these companies go ahead and recognize, or in other terms, record those particular shares or debentures in their books of account? According to IFRS 9, this started here, financial instrument, whether issued or basically whether purchased, should be recognized. Should be recognized. Recognized. Question once 3B. Once an entity becomes a party, to the contractual relationship, becomes a party to the contractual relationship. What does that mean? It basically means that once this company has issued these particular shares or debentures, even if our company has not been paid for the shares, for those particular has not received cash for the shares or debentures which have been issued, our company has already become a party to that contract simply because it has already issued the shares or debentures. The same case. Once this company purchases the shares or debentures issued by this company, even if this company has not paid for those shares or debentures, this company should go ahead and recognize that in its books of account as a financial asset. So therefore, according to IFRS and unlimited use of financial instrument should be recognized in the company's books of account whenever an entity becomes a party to the contractual relationship. Then next, I want us to discuss something to do with the recognition of financial instruments. The recognition basically is the direct opposite of recognizing. The recognition is the direct opposite of what? Recognizing. The recognition of a financial instrument. So by definition, we say to be recognized is to remove a financial instrument from the entity's statement of financial position. It is the process of removing a financial instrument. If, for example, a company had issued debentures, so those debentures may be removed from the balance sheet, may be removed from the statement of financial position, maybe because they have been redeemed. So that process through which financial instruments are removed from the statement of financial position, we refer to that as the recognition. So this is the removal. This is the removal of previously recognized financial instruments from entities statement of financial position. A company had issued debentures, but now those particular debentures have been removed from the statement of financial position. They will no longer be shown there as a liability. That process we refer to it as the recognition. Now, when can the financial instrument be recognized? We have various criteria upon which the financial liabilities can be recognized, of which in this case we are going to look on the recognition criteria for both the financial assets and also the financial liabilities. But even before we look on the criteria here, you have to recall what is a financial asset. A financial asset, basically, I've said that this is an investment in a debt instrument, For example, if today you have some cash in your bank, instead of money staying there, you may decide to invest in government securities. You go to you buy government securities having a value of 1 million, and then you'll be earning some interest. Once they mature, you're given back your money. So that investment in government securities to you is a financial asset. Sasa? Yes. So a question then arises: when should the company remove financial asset from its books of accounts? There are two criteria when that may happen. One is when the entity transfers the rewards and the risks associated with the financial asset. When the entity transfers the risks and the rewards associated with the financial asset. What does that mean? And let's assume that we have a company here, company X, and this company has invested, for example, in debentures of another company. So to this company, we are saying that investment in debentures is a financial asset. So when should this company, or when can this company remove those financial assets from its statement of financial position? One of the circumstances when this company transfers the risk and reward. So generally, what we know, anytime you have undertaken an investment, anytime you have invested, there are some rewards, there are some risks associated with that particular investment. But when can you transfer those rewards and risks? So to transfer is basically when you sell. So meaning that once this company sells this particular debentures, then we say that the company has transferred the risk and rewards. It is obvious that once you have sold an asset, you cannot continue showing it in your balance sheet because it has already been sold. You have transferred the risk and rewards. They recognize that, remove that asset from your balance sheet. Number two is when the entity's right to receive cash expires. When the entity's right to receive cash has done what? Has expired. So the entity's right to receive cash has expired. So generally what we know is that once you have invested, for example, you have invested in treasury bonds having a life of 2 years, it basically means that you have a right to earn interest from the government for the next 2 years. At the end of the second year, once those treasury bonds mature, you'll be given back the principal amount you invested. So meaning at the end of the second year, your right to receive cash will come to an end simply because those particular treasury bonds have been redeemed. They have matured and the government has done what? Has redeemed them, and you have been given back your principal amount. So if you are a company and basically you had shown that as an asset, you cannot continue then showing that as an asset simply because your right to receive cash has expired. You have earned interest for the next 2 years, and then at the end of the second, you have been given back your principal amount. Then there is no way you will continue showing that as an asset in the statement of financial position. So therefore, the other criteria for the recognizing financial asset is when the entity's right to receive cash has expired, maybe because the debt instrument which the company had invested in have matured and they have been redeemed. So in this case, we have those two criteria. Those as the two criteria upon which a financial asset may be recognized. And in this case, we have said it's important for you to understand what is a financial asset. It's basically an investment in shares. It is an investment in debt worth securities. At a later stage, we are going to look on the various categories, the various ways in terms of how we classify the financial asset. But next, I want us to look on the criteria or the criteria for recognizing a financial liability. Financial liability. What is a financial liability? A financial liability basically here is, we say is an obligation to pay cash. Is an obligation to pay cash. An obligation to pay cash generally arises whereby a company has issued debt securities. Like assuming we have company X, that company has issued debentures, that company has issued both, maybe having a life of 2 years. So that company has an obligation to pay interest for the next 2 years. And once those debentures or both mature, the company must redeem them by paying back the principal amount. So therefore, a financial liability here, this is a financial obligation to pay cash. Financial obligation to pay cash. Cash. And basically this arises whereby a company has issued some debt instrument. Debt instrument issued by the company is a financial liability. So when should the financial liabilities be recognized or removed from the statement of financial position? Here we have just one criteria, and that is when the entity's when the entity's obligation to pay cash expires. When the entity's obligation to pay cash has done what? Has expired. What does that mean? It basically means that, or assuming you have a company here, company X, this company has issued debentures, and these debentures have a life of 3 years. Having a life of 3 years means that this, or in this case, this company will be required to pay interest at the end of year 1, at the end of year 2, and also at the end of year 3. And then at the end of year 3 here, these particular debentures will be redeemed. And the company will pay back the principal amount. So once the company pay back the principal amount, then we say that the obligation of this company to pay cash will expire at the end of year 3. So it is obvious that because those particular debentures have been redeemed, the company cannot continue showing them in the balance sheet as a liability. They have already been redeemed. So in that case, then we say that those debentures, those financial liabilities have been what? Have been recognized. They have been removed from the entity's statement of financial position because the obligation of the entity to pay cash has done what? Has expired. Expired. Yes. So that, or those are basically the various criteria upon which financial assets and financial liabilities may be recognized. So you may come across a zero question asking about this, whereby you're required to explain the criteria for the recognition of financial assets and financial liability. So next, I want us to look on something known as the compound financial instrument. So compound financial instrument, these ones are abbreviated as CFI. So what do you mean by compound financial instrument? So these are the financial instruments, things like debentures, things like bonds, which contains both equity and liability component. So therefore, these are financial instruments, which contains both equity. They contain both equity and liability component. They contain both equity and the liability component. Equity and liability component. Now, what is a good example of this? What is a good example of a compound financial instrument which contains both equity and liability component? Examples of this include the convertible securities. The convertible securities. So what do you mean by convertible securities? These are the securities which can be converted, or basically these are securities where the holders have the right to convert them into ordinary shares. The holders have the right to convert them into ordinary shares. And actually, good examples of these convertible securities include the convertible debentures, the convertible bonds, maybe the convertible loan stock, And why do we refer to these securities as convertible? Why do we refer to them as convertible? Is because the holders of these securities can be able to convert them into ordinary shares. I hope you can be able to remember in company law. In the topic of the debt instrument, you talked about different types of debentures, and you're told that one type of debenture which may be issued by the company is convertible debentures. These are debentures which you can be able to convert into ordinary shares of the company. So therefore, anytime you come across a debt instrument, like debentures, like bonds, like loan stock, which are convertible, then we say that they are compound financial instruments. They contain both equity and liability component. Now, why do we say that these compound financial instruments or these convertible securities contain equity and liability components? Two reasons. One, the company which issue these securities, one, we say the issuer is basically the company which has issued. The issuer, the company which has issued these convertible securities, has an obligation to pay cash. What does that mean? It basically means that assuming company X has issued convertible debentures, then we are saying that this company has an obligation to pay cash. The cash to be paid by this company is interest and the principal amount. If the holders of these debentures will not convert them into ordinary shares, once they mature, our company will be required to do what? We will be required to redeem them by paying back the principal amount. So the issuer, the company which has issued those debentures, has an obligation to pay cash. This obligation to pay cash to accompany this is a liability. This obligation to pay cash to the company is what? Is a liability. This financial obligation to pay cash is a liability. If you have taken a loan from a bank, basically you have to repay back that loan. To you, that is a liability. If a company has issued debentures, our company has to pay interest, and once the debentures mature, the company has to pay back the principal amount. That is a liability to our company. So that's why we are saying that these convertible debentures, they have liability component. The company which has issued them has to pay cash. Number two, we say that the holders of these compound financial obligation, the holder has a right to convert them, into ordinary shares. So basically, if you hold some convertible debentures, you can be able to convert them into ordinary shares of the company. What does that mean? It basically means that you have a right to receive ordinary shares of the company. Naturally, that right to receive the ordinary shares of the company, that one we refer to it as equity, because equity is whereby you have already bought the shares of the company, or you have the right to buy those shares. You have the right to be issued those shares. We are saying you hold convertible debentures which you can be able to convert into ordinary shares. So that right you have to convert those securities into ordinary shares is called what? Equity. So this why we say that all convertible securities contain equity and liability component. We have said they contain a liability component simply because the company which has issued them has an obligation to pay cash. The cash to be paid here, we have said, will be in form of interest. The cash to be paid here will be in form of interest and the principal amount. Number two, we have said they contain the equity component simply because the holder of those convertible securities can convert them into ordinary shares, has the right to convert them into ordinary shares, which basically we are saying is what is an equity in itself. Now, this compound financial instrument should be accounted for in accordance with a different standard, not IFRS 9, but they should be accounted for in accordance with International Accounting Standard number 32. This standard, IAS 32, basically requires that anytime a company has issued compound financial instrument, the company should split these two components. The company should split the equity component and the liability component and account for them separately. So therefore, this standard, we say IAS 32 requires an entity to split the two components. To split the two what? The two components. So which are the two components here? The equity component and number two, the liability component. So those two components must be separated, must be split in other terms, and be accounted for separately. I want us to look on how basically we do that particular split. But even before you do that, you can confirm whether we are together up to that point. I hope you're together up to that point. Are we together up to that point? Maureen, Kennedy, Ismail, Wanyama, are we together up to that point? I hope you're getting the video from your end clearly. I hope you're getting my sound is perfect. My sound is okay from your side. Okay, sawa. Let's continue. Then, if you're together up to that point, we can proceed. Now, what I've said is that this particular standard, IAS 32, requires that anytime the company has issued securities which are convertible debentures, convertible bonds, convertible on stock, which contains equity and liability component, the company should split the equity and the liability component. How should that split be done? So we have two steps to be followed. The step number one is that the company should compute the liability component. Step one, for us to basically compute the liability component. So in this case, if you can be able to recall, we have said this liability component arises as a result of the company's obligation to pay cash, which is in form of interest, which is in form of principal amount. Like assuming in this case, a company has issued debentures having a life of 3 years, year 1, year 2, year 3. So a company has issued convertible debentures having a life of 3 years, year 1, year 2, year 3. So in this case, we have said at the end of year 1, at the end of year 2, at the end of year 3, our company will be required will pay the principal amount, and also at the end of year 3, the company will be required to pay. I've said at the end of year 1, at the end of year 2, at the end of year 3, the company will be required to pay the annual interest. And then once they mature, that is at the end of year 3, the company will be required to pay back the principal amount. But in this case, here we assume that the holders of this particular convertible debentures will not convert them into ordinary shares. Shares. So if the holders will not convert them into ordinary shares, for the next 3 years, the company must pay interest on annual basis, and at the end of the third year, the company must do what? Must redeem them by paying back the principal amount. So how do we therefore compute the liability component? To compute the liability component, which has to be computed on the date of the issue here, we compute that by discounting all this. To discount basically entails computing the present value. So we get the present value of the interest to be paid annually and the present value of the principal amount. So meaning that the liability component component. And basically, this liability component is computed on the date of the issue. Or in other terms, this split should be done on the date of the issue. The date they were issued. If they were issued 1st January 2023, that is when we split the two components. Sasa? Yes. So to compute this liability component, the liability component here is equal to the present value of the annual interest So basically, I hope you know how to discount this. Remember, these are annuities, this and this, because these are similar cash flows. So these are annuities. So you know how to discount that from financial management. And then to this, we add the present value of the principal amount. The principal amount is this amount, which is payable upon redemption. So basically, we do what? We add these two figures: present value of annual interest plus the present value of the principal amount. That is how we compute the liability component on the date of the issue. After computing the liability component, step number 2, we proceed and we compute the equity component. Step 2, compute the equity component. So how do we compute the equity component? To compute this equity component, we take the total proceeds. So basically, in this case, when we talk about the total proceeds, this refers to the amount of money which was received by the company after issuing these convertible debentures. So how much amount was received? This, in other terms, is known as amount received. The amount received, or in other terms, the total proceeds. So total proceeds, and then to this we less the liability component. Which you have computed in step number 1, which you have computed here in step 1, which you have computed there in step 1. I hope you can be able to see down there. Yes, which you have computed in step 1. Step number 1. Yes, so computed in step number 1. So after deducting that, we get the difference here. And this difference is the equity component. It's also important for me to mention that the value for this equity component, basically this one remains constant. The value for equity component, which has been computed on the date of the issue, will remain the same in year 1, year 2, year 3. So that remains constant. The value for equity component does not change. But this value for the liability component, which I've computed in step 1, remember this represents what the company will pay in year 1, year 2, year 3, year 4. So take into account this like a loan. If, for example, today you go to a bank, you take a loan for 5 years. So that means that for the next 5 years, you have an obligation to pay back that loan. So, and basically what that means that generally you should prepare something, or a bank prepare something called a loan amortization schedule to gradually write off that loan, such that at the end of the 5th year, the value for the loan will be 0. The same case, this liability component, we amortize it. This liability component, we do what? We amortize it. To amortize a liability or even amortizing an asset, this is the process of gradually writing off an asset, gradually writing off a liability over a given period of time. So therefore, these are basically the 2 steps which we follow to do what? To split the equity component and the liability component. The equity component and the liability component, equity component and the liability component of a compound financial instrument, instrument. I think with that particular knowledge, we can go to the past papers. I want us to do a question from the past papers. And maybe for those who are coming from CPA intermediate level. There was a question which was examined on this in FRA, and maybe if you are in my class, automatically we did that question. So I want us to do another question, basically from AFR. So someone is asking here, how do we get the amount received? Total proceeds. Total proceeds always will be told how the debentures. For example, in this case, you can be told the company issued debentures having a par value of 100 million, at a discount of 10%. At a discount of 10%. In this case, to compute the amount received is quite simple. The debentures issued had a value of 100 million, but you can see they were issued at a discount of 10. Did our company receive the full amount of 100 million? Yes or no? Did the company receive an amount of 100 million? No. The amount received in this case would be 90% of 100 million. So the amount received in this case is computed always based on the information which is provided. So the examiner will give you information which basically will assist you in terms of computing the amount which was received. So I want someone to share the past papers in the class WhatsApp group. Someone to share the past papers in the class WhatsApp group so that I can tell you the question I want us to do. The question on compound financial instruments. Yes, I hope those past papers have been shared there in the class WhatsApp group. Yes, I can see they have been shared there by Ismail. So the question I want us to do was, I think, tested some time back, not too back. Let me see. Yes, there was a question from this topic, though it is not in relation to compound financial instrument. This was just a small question. I think it was in the sitting of 2021 there. A question for Naivasha Company Limited. Just a small question. I'm trying to retrieve that question here. Yes, so it is a question from May 2021. May of 2021. And this is question number 4B. Question 4B. So let's go to this particular question here. 4B, May 2021, question 4B. So once you get the question, just confirm that you have the question with you. So once you get the question, just confirm. Okay, confirmed by Otunga there. Yes, 𝐎𝐍𝐋𝐈𝐍. Mercy has confirmed. Maureen, are you there? Diana, you have the question with you. Eddie, Faith, Patrice, Samuel, you have the question with you. Do you have the question with you? Yes. Yes. So what are we told here? What are we told? What are we told? Just a small question, but you can see the question had 6 marks. So the question reads, Naivasha Limited issued 500 convertible loan notes on 1st January 2018 at par. They were issued at par. Each loan note is redeemable in 3 years' time. In 3 years' time at its par value of shillings 2,000 per note. Alternatively, each note can be converted at the maturity date on 1st January 2021 into 125 shillings 10 ordinary shares. And then in this case, we are told that the loan notes pay interest annually in arrears at a coupon interest rate based on the nominal value of 6%. The prevailing market interest rate for 3 years loan notes without conversion rate is 9%. So what are we required to do here? We are required to prepare the extract of financial statements of Naivasha Limited for each of the year ended 31st of December 2018, 2019, and 2020. The marks allocated here were 6. Now, what is important first of all here? So the first thing, or basically the first important thing to do here is basically to see that these loan stock or these loan notes which were issued by our company, they are convertible. They are what? Convertible, because we are told the company which is called Naivasha Limited issued convertible loan notes. So anytime you see the word convertible, what you need to remember very fast is that this is a compound financial instrument. This is what? A CFI. Because I've said all convertible securities, all convertible debt instruments, they contain both equity and liability components. Therefore, on the date they were issued, what our company was supposed to do here is to split the equity component and the liability component. So therefore, maybe here we can say that these convertible loan notes issued by Naivasha Limited. Naivasha Limited is a compound financial instrument. So having known that, then you need to record what you have said. We have said, according to IS 32, on the date of the issue, the company should split the equity component and the liability component. The company should split the equity component and the liability component. Equally here, we have discussed the 2 steps to be followed, basically in computation of the same. So what I want us to do is we basically go straight to splitting the equity and liability component. And we are going to start by computing the liability component. Step number 1 we have said is to compute the liability component. And actually this one is always computed on the date of the issue. So when were these compound financial instruments issued? They were issued on 1st of January 2018. 1st January 2018. That's when we should do the split. So how do we compute this liability component? The liability component you have said is equal to the present value of the annual interest, present value of the annual interest of the annual interest plus the present value of the principal amount. The principal amount. So if you can be able to remember that, then it becomes quite simple. So we need to first of all compute how much interest will be paid by a company on annual basis, how much amount will be paid on redemption, because you have said the principal amount is the amount to be paid once this convertible loan stock matures and they are redeemed. So first of all, to compute this one, to compute the annual interest, or basically in other terms, the interest to be paid annually, the interest per annum. How do we compute this one? This formula is very important. You must recall this. This one is computed by taking the coupon rate. The coupon rate times the par value. The par value is also known as the nominal value. It is also known as the face value. The face value of the compound financial instrument. That formula, very, very important for computing the interest to be paid on annual basis. The coupon rate times the par, the nominal or the face value of this compound financial instrument. Remember, compound financial instrument are the 8% loan notes. Now, equally, if you check on this, the information which are given in this particular question, the information given in this question, you will see that we have two interests. Where do we have the first interest? The first interest is given, I think, in which paragraph? I think both of them are given in paragraph 2. Yes, can we go back to paragraph 2? In paragraph 2, we are told the loan notes pay interest annually in arrears at the coupon interest rate of 6%. So in our case, we already given the coupon interest rate. The coupon interest rate, which is 6%. But in most of the cases, the examiner will not tell you which interest rate is coupon rate. But if you're given something like this, you're given 10% convertible debentures. This particular interest, which comes before the name of the compound financial instrument, this is what we refer as the coupon rate. The coupon what? Rate. Yes, but in our case, we are told the coupon rate is 6%. So we multiply that with the par, nominal, or the face value of the CFI. CFI are the convertible loan stock. Now that information is given in paragraph 1. Can we go back to paragraph 1? In paragraph 1, you're told Naivasha Limited issued 500 convertible loan stock. 500 convertible loan stock. This is the number. The convertible notes issued were 500. And then you're told they were issued on 1st January 2018 at par. And then you're told each loan note is redeemable in 3 years' time at its par value of 2,000. So the par value of each loan note is how much? Is 2,000. So therefore, we need to multiply this coupon rate, because we already have the coupon rate, times the par value of the convertible notes. So we are told the convertible notes which were issued by the company, they were 500. But remember, this is just the number. We need to get the par value, the total par value of this. So what does that mean? It basically means that we have to multiply this with the par value of each, because we are told the par value of per loan note, the par value per loan note is 2,000. So meaning that the total par value of these loan notes which were issued will be 500 times what? Times 2,000. So how much interest will be paid by our company on annual basis? On annual basis. So give me the final figure here. The interest to be paid by our company on annual basis will be how much? Will be how much? So which should be 6% of 500 times 2,000. Yes, I'm given a figure for what? Yes, I'm given a figure of 60,000. I'm given a figure for 60,000. So 60,000. So this is the interest which will be paid by our company per annum. And from the information which we are given here, this interest will be paid for the next how many years? Assuming these convertible loan notes will not be converted into ordinary shares. if they will not be converted into ordinary shares, this interest will be paid for the next how many years? This interest will be paid for the next how many years? Yes, automatically this one will be paid for the next 3 years, because we are told that this particular raw note will be redeemed after 3 years. So if they will not be converted into ordinary shares, the company will have to redeem them at the end of the 3rd year. Yes, so therefore this means that this interest, which is annual, will be paid in year 1, year 2, year 3. Also, we are told, I think in which paragraph? In paragraph 2, we are told this interest is payable in arrears. Payable in arrears means that it is payable at the end of each year. So the company will pay 60,000 at the end of year 1, at the end of year 2, at the end of year 3. So having that, then we need to determine this one, the principal amount. So that then we proceed and discount those two items and we add them. So what is the principal amount? Remember, the principal amount is the amount to be paid on redemption. Amount payable on redemption. Amount payable on what? On the redemption. So the amount to be paid on redemption, this one is always equal to the par value. To the par value. If you have invested 2 million in treasury bonds, once they mature, you should be given back your 2 million. Yes, so they're redeemable at par value unless otherwise stated. Unless otherwise stated. So there are some questions you may come across, and you're told that this compound financial instrument will be redeemed maybe at a premium of 10,000. So if they will be redeemed at a premium of 10,000, you take the par value, like in this case, the par value will be $1 million, plus now the premium. Plus the premium. That is the amount to be paid on redemption. But if the question is cited, the amount to be given back on principal on the redemption should be equal to the par. Although in this question we are given that information. Paragraph 1. Paragraph 1, sentence 2, we are told each raw note is redeemable in 3 years' time. In 3 years' time at its par value. So the amount to be paid on redemption is the par value. So the par value in our case, we know, is equal to 2,000 per raw note, this one, and then times the total number of raw notes which were issued. So this should give us $1 million. $1 million. So the amount to be paid on redemption will be how much? Will be $1 million. So what we need to do now, because we have the annual interest, we have the principal amount, we just need to discount them. So there are so many, there are a number of approaches we can be able to use to discount this. Let me use an easier one, whereby we are going to have years, year 1, year 2, year 3. Because we know that in year 1, year 2, year 3, the company will pay this. And then also at the end of year 3, the company will pay how much? 1 million. So, and then here we can have like what? We can just refer to this as cash flows, the amount to be paid by our company. So in year 1, our company will pay 60 million, the annual interest. Because we have said this interest we have said it will be paid in year 1, year 2, year 3. 60 million, 60,000, 60,000, 60,000. And then at the end of year 3 here, once they mature, the company will also pay back the principal amount. That is what we need to know. The amount to be paid at the end of year 1, 60, at the end of year 3, 60 plus $1 million. Yes, I'm saying we refer to those as cash flows. So then in year 3, we are saying the amount to be paid here will be $1 million plus 60,000. Plus 60,000. So what do we need to do? We need to discount this. So to discount this, we need to multiply this with something called the present value interest factor. Which rate are we going to use here? The rate we are going to use is something called the effective interest rate. If you check on that question, we're also given another rate other than this, the coupon rate of 6%. In paragraph 2, we are told paragraph 2, the last sentence, the prevailing market interest rate for 3 years raw notes without conversion option is 9%. So that 9% is the one which we use for discounting here. So we multiply this with the present value interest factor at the rate of 9%. This one should be 9%. This one should be 9%. So how do we compute these values? Mostly in financial reporting, you not be given those present value interest factors tables. So you must remember the formula. So the formula for this is 1 plus R raised to power negative N. 1 plus R raised to power negative N. For example, in the first year here, the first year, our present value interest factor will be equal to 1. Remember, our R is 9%, 1.09 raised to power negative 1. Our N is this is N here. In year 2, 1.09 raised to power negative 2. In year 3, 1.09 raised to power negative 3. Raised to power negative 3. So in year 1, I hope that is the value which I'm given, 0.9174. What about year 2? Year 2, this is how we computed 1.09 raised to power negative 2. Raised to power negative 2, raised to power negative 2, raised to power negative 2, that is 0.8417. Yes, you give me that figure to the nearest 4 decimal places. And the last one I'm given Diana here, 0.7722. Yes, having that, then we need to proceed and we compute the present values. The present values would be whatever you have here times the present value interest factor. So what are we going to have for the first year? The first year, 60,000 times 0.9174, 55,044. 55,044. What about year 2? 60,000 times 0.8417, which will give us 50,502. Year 3, 1,060,000 times 0.7722. I'm given by Eddie here, 818. Which figure is correct? The figure from Eddie, the figure from Diana? Yes, should be 818, 532. 532. Then what we need to do basically is now we add this. Remember what we are computing here. What are we computing? We are computing the liability component. The liability component we are saying is the present value of the annual interest. The annual interest is 60. That is the annual interest plus the present value of the principal amount. Principal amount 1 million. You have said this one will be paid at the end of year 3. So let's compute this liability component. This liability component on the date of the issue, which is this date here, 1st January 2018. What are you getting as the total? You add all this. You add those figures. You give me the total. 924. 924. 078. 078. That is the figure I'm getting from Mercy here. I'm also getting the same from Diana. So what we have there, therefore, is the liability component. The liability component. So having the liability components, then what do we need to do? Step number 2, because we are done with step 1. Step number 2, we need to proceed and we do what? We compute the equity component. We compute the equity component. Equity component. Remember, basically, this part of the workings, we have not yet answered our question. If you take on what the examiner was requiring, we do what? We prepare financial statements extract. Prepare financial statements extract. So will the approach in liability, in computing the liability component be different? If interest is paid at the beginning of the interest, yes, it would be different, but practically, is it possible for interest to be paid at the start? No, profit is payable at the end because you have invested. The company can only pay you interest based on the profit. That's based on the profit. Though there are those particular short-term government securities, treasury bills, the interest is payable in advance. Yes, for the short term. But I think this long term, the interest is payable at the end. Sasa, it is payable at the end. Payable at the end. Sasa, yes. So let's move and we compute the equity component. Equity component. Equity component will also be computed on this date, the date of the issue, 1st January 2018. 2018. So how do we compute this one? So remember, I've given you the formula: the total proceeds, the amount received, minus the liability component, which we computed in step 1. The liability component computed in step 1 is what we have here: 924,078. So we need to determine how much amount was received. This convertible loan notes, how are they issued by the company? If you go back to the information which are given in this particular question, specifically in paragraph 1, you're told Naivasha Limited issued 500 convertible loan notes on 1st January 2018 at par. They were issued at par. So the amount which was received, here will be equal to 500. And basically, we know the par value for each is 2,000. So the amount received was $1 million. This is the amount received by the company, 1 million. So we take 1 million, the amount received, minus the liability component. Whatever you get here, this one is known as the equity component. The equity component still on 1st January 2018. So what will be the equity component on the date of the issue? The equity component, the difference between 1 million and 924,078. What are you getting here? 229. 75 what? 75,922. 75,922. Yes, so that is the equity component. If you can be able to recall, we said the value for this equity component will not change in year 1, year 2, year 3. That value does not change. But now, this one, which basically is the liability component, this one we have said we must do what? This one we have to amortize it. We have to do what? This one we have to amortize it. This one must be amortized. This one must be what? Amortized. This one has to be amortized. So how do we amortize a liability in this case? From what you did in financial reporting, how do we amortize this? How do we amortize a loan? How do we amortize something like a risk liability? What do we have to prepare here? We prepare something called what? Even when amortizing a loan, you prepare something called the amortization schedule. The amortization schedule. So we need to prepare amortization schedule because we have not yet answered our question. If that question you leave it like that, you'll not be able to score the marks. So the question was requiring what? We prepare financial statements extract. We basically show what the company was supposed to account for in the income statement for 3 years and what the company was supposed to account for in the statement of financial position for 3 years. For us to be able to do that, we must first of all amortize this because there are a number of things we are going to compute from that amortization schedule, which the company was supposed to account for, both in the income statement and the statement of financial position. So what I want us to do, we amortize this liability here. We amortize the liability. And basically to amortize this, we have to prepare something called the amortization schedule. So to some extent, it's almost the same with the loan amortization schedule because this is now what we want to gradually write off, such that at the end of year 3, it should be 0. So here we have various columns. The first column will be for the years. So we may decide to use year 1, year 2, year 3, year 4, but basically we know that the first year started on this date, 1st January 2018. So it means that the first year will end 31st of December 2018, the second year 31st of December 2019, the other year 31st of December 2020. So what do we want to amortize? This one, the liability. So the first column here will be for the liability at the start, and take into account the interest is payable in arrears. The interest is payable in arrears. The next column here should be for the interest. And actually this interest, always we compute it based on the coupon, we compute it based on the effective interest rate, the market interest rate. If you can be able to recall our effective interest rate, the rate we have used for discounting was 9%. That is, we compute this interest based on this market interest rate, not the coupon rate, the market interest rate. And then here we have the cash paid, and then we will have the last column here, which is the liability at the end of the year. Remember, this is just like Karun. This is just like Karun. How do you compute the loan balance at the end of the year? To compute the loan balance at the end of the year is very simple. You take the loan balance at the start, you add the interest, and then you less the installment you paid. You'll be able to get the loan balance at the end. So that loan balance at the end of year 1 will become the loan balance at the start of year 2. Compute interest, deduct the cash which was paid, you compute this one. And actually computing the loan balance at the end, you take the loan balance at the start plus interest minus cash paid. Minus cash paid. Yes. So in this case, here we don't talk of installment. This cash here is the same with installment. With installment. But equally in this case, if you can be able to remember in FM, financial management, you compute the installment which is paid, and that installment, I think you split it. You go ahead and split it into two: the principal amount and the interest. Is that the case? That's what you do. Here we don't have to do that. We don't have to split the installment paid in form of interest, in form of principal amount. Yes. So the liability at the start of the year, because what we start here should be the liability at the start of year 1, is what we have computed here. That is the amount we want to amortize. 924,078. So that is what we want to amortize up to the end of year 3. At the end of year 3 should be 0. So then we compute the interest. The interest should be 9% of this, 9% of the liability at the start. So that will be an amount of how much? That will be an amount of how much? An amount of how much? An amount of how much? Amount of how much? 80? Is it 83, 87? Are you getting 83 or 87? I'm getting different figures there from Diana, from yes, 80. What are you getting here, Patrice, somewhere? No, but which figure are you getting here? 83, 167. 83, 167. I wanted to see whether we are together. Can someone tell me how much cash was paid by our company in year 1? Nataka tuone kama tuko pamoja. Our company here, this company which had issued this 6%, is it 6%? 6% convertible loan notes. How much cash did it pay to the holders of those convertible loan notes? How much cash was paid? I see whether we are following what we are doing here. I see whether we are together. The cash paid by our company is what we have here. These are the cash paid by our company, year 1, year 2, year 3. Yes. So the cash paid here was 60. So how do we compute the liability at the end of the year? Remember, I've said it's just like a loan. So this is the loan balance at the start. This is the interest charged during that year. This is the cash paid. To compute the loan balance at the end, we take the loan balance at the start. We add the interest for that year. We minus whatever was paid. So therefore, this one will be equal to this plus this minus cash paid. The amount to be deducted, we put it inside the bracket. Give me the liability at the end of that year. Yes, what are you getting? Gordon, it cannot be 231. It can't be 231. That one automatically is wrong. It should be around 900 and something. 940, 947, 47 to 45, 245. So that will be the opening balance in the following year. 947 to 45. And then we compute interest here as 9%. We compute interest here as 9%. Yes, what are you getting? The interest, 9% of this, 85 to 52. 85 to 52. The cash paid also is 60. So give me the liability at the end of year 2. The liability at the end of year 2. Yes, what are you getting? The liability at the end of year 2. The liability at the end of year 2, 972. 972 for 97. 497, that will be the opening balance now here. 972, 497. So the interest, which will be 9% of this, 9% of this. 9%, 87, 524. 524. Now, we know at the end of year 3, the company is supposed to redeem them. The company is supposed to redeem them. So we are saying to compute this one, liability. We are saying this just like a loan. This was your loan at the start. This is the interest you are charged, but you paid this. You paid this. How do you compute the loan balance at the end? You take the loan balance at the start plus interest minus this. So this one is computed by taking A plus B minus C. This loan balance plus interest minus cash paid. Sasa, yes, that's how we compute that one. How we compute that one. I hope that is understood now. Now, here we know the cash which was paid was 1,060,000. But if you check on the question here, when was the principal amount paid? The principal amount. Are we given the date when the principal amount was paid? The 1 million. When was 1 million payable? Because in most of the cases, we'll be told it will not be paid exactly on 31st of December 2020, but you can be told it will be paid on 1st January of 2021. I think that's what we were told. This 1 million, when will the redemption take place? Yes, the redemption, this 1 million will not be paid at the end of this year, but will be paid the following year, the following day actually. So therefore, in preparing our amortization schedule, what we put here is 60, because at the end of the year, will the company pay 1,060,000? No, the company will only pay interest. And basically, it means that once you prepare this, even without computing this, here you should be left with 1 million. You should be left with 1 million, and this 1 million will be paid on 1st January of 2021. That is when it will be paid. So therefore, it was not paid here. That's why we are not including 1 million. So, but if the question is silent regarding when this amount will be paid, regarding when this debt instrument will be redeemed, then we would have included 1,060,000. Are we together? Yes. Are you getting 1 million there? You may get a figure which is not exactly a million because we have rounded off, but it should be a figure of 999 something. Are you getting 1 million, or are you getting a figure of 99? Yes, it should be 1 million. This one will be paid in the following day. Now, having that, we can wind up the question now by doing what? By answering our question. So what are we required to do? We are required to prepare financial statement extract. Financial statement comprises of the income statement, comprises of the statement of financial position. We need to prepare income statement extract. Remember, an extract is part of something, is part of the income statement. This is not the complete income statement. We are preparing this income statement to show what was supposed to be included in this income statement for 3 years in relation to this compound financial instrument. So let's do that. We prepare income statement extract. Basically to show what the company was supposed to recognize here for 3 years. The first year ended 31st December 2018, 31st December 2019, 31st of December 2020. And what the company was supposed to recognize in the income statement is this interest. This interest. So this interest should be recognized in the income statement as part of the finance cost. As part of the finance cost. So therefore, in the income statement, specifically at the expenses, the company was supposed to recognize this interest, but basically any form of interest will be recognized in the income statement as part of the finance cost. As part of the finance cost. So therefore, the finance cost for the first year is this one, 83,167. In year 2, this one, 85,252, and year 3, 87,524. 524. That is what was supposed to be recognized in the income statement as far as this compound financial instrument are concerned. What about the statement of is not a complete statement of financial position? So equally for 3 years, 31st December 2018, 31st December 2019, 31st December 2020. So in the statement of financial position, our company basically here was supposed to recognize 2 items. One, the liability component of this convertible loan notes, and number 2, the equity component. So 2 items. And the first item, basically what we know is that in preparing this, we record assets, non-current, current, we record equity followed by liability. So in this case, because we don't have any item of assets, we basically start by showing what was supposed to be recognized here as part of equity. As part of equity, and what the company was supposed to recognize here at the equity is this one. This equity component. Remember, we have said the value for equity component remains unchanged in year 1, year 2, year 3. That one will not change. That's why we said it remained constant. So at the equity, the company was supposed to recognize something called the equity component. Equity component of the convertible loan notes. So make sure you write that in full. Equity component of convertible loan notes. Equity component of convertible loan notes. The value for that is 75,922. This one we are saying will not change over the period of 3 years. That one remain the same. That one remain the same. This one remain the same. Remain the same. Then other liabilities, the company will recognize something called the liability component. The liability component of the convertible loan notes. The liability component of convertible loan notes. Convertible loan notes. And where do we get these values to be recognized as the liabilities? We get those values here from the amortization schedule. So from this amortization schedule. So this is the liability which was supposed to be recognized in year 1. 947,245. That one. Year 2, this one, which is the 972,497. And year 3, this one, 1 million. 1 million. 1 million like that. 1 million like that. 1 million like that. 1 million like that. Yes. $1 million like that. And basically that's what was required as far as that question is concerned. All what you have done, all this was part of working. So the marks are allocated here. This is what will earn you the marks. This is what will earn you the marks. This is what will earn you the marks. Though in this particular question, the examiner was too mean. I've seen there was a question which was tested on this in FR. Maybe for those who are my student in FR, we did such a question. And that question, the marks allocated in that question were 10. So, but this question, the marks allocated were 6. This is a question basically, the examiner should give at least 8 marks, because you can see the question is a little bit what? Demanding. Yes, so that is it. That basically what is required as far as that question is concerned. I hope if you come across a similar question, you can be able to handle it. That. But I've said what is important as far as this is concerned is basically anytime you see the word convertible, what you need to remember very fast is that is a compound financial instrument. If it is a compound financial instrument, you must go ahead and basically do what? Split the equity component and the liability component. The equity component and the liability component, and then from there you must proceed and you do what? You amortize the liability component, and then for the equity component, you have said that value remain the same. I want to give the question from FR as an assignment. I think this was from the sitting of August 2024, from the paper for financial reporting, intermediate level. Let me share that question with you. Is it August? Let me see. No, it was basically April, although let me do a screenshot. Yes, so I've shared that question in the class WhatsApp group. The question from financial reporting and analysis. This was a question for April 2024. Specifically, this was question 5. I think question 5B. Is basically the same. Is the same with whatever you have done here, because we are told that company, which is called 𝐍𝐻𝐻, had issued 9% convertible loan notes. 9% convertible loan notes. And basically what the examiner was requiring here is with suitable calculations demonstrate the accounting treatment of the above transactions in the books of accounts. So if you're required to demonstrate the accounting treatment in the financial statement, you are required to prepare financial statement extract, just like what you have done here. Then I hope you have seen that question which I've shared with you. If you go to the question, I've already shared the question in the class WhatsApp group. If you go to that particular question in the requirement, you are told to round off your answers to the nearest 1,000 of shillings. So if you're given those instructions by the examiner, that you round off your answers to the nearest 1,000 of shillings, round off answers to nearest 1,000 of what? 1,000 of shillings. So basically what that means is that when, for example, preparing the amortization, say what you do, you work your figures with 1,000 of shillings. With 1,000 of shillings, that means that any figure which you have, you omit the last 3 zeros. And any figure having a decimal, you round it off to the nearest whole number. Sasa, Yes. So in that case, you will not work with the full figures, but you work with the figures in thousands of shillings. For any figure which you get, let me give an example of what I mean here. So like if you check on that particular question in paragraph 1, you're told this company issued convertible own stock having a value of 120 million. 120 million like that. So when working out this question, you do not work with this particular whole figure, but what you'll do, you'll omit the last 3 zeros. But for example, when preparing the amortizations that you have there, you must note that your figures are in thousands of shillings. When preparing this income statement of financial position, you must come here and you note your figures are in thousands of shillings like that. Are in thousands of shillings like that. And if you come across a figure having decimals, you must round off to the nearest whole number. To the nearest whole what? Number. Sasa? Yes. So I want to give that particular question as an assignment. And also for today, I want us to stop at that point. I can see we have around 15 minutes. We can't be able to do something constructive. So once we meet in our next session, we will be able to talk about types of financial assets, the classification of financial assets, and also we talk about financial liabilities. And then from there, we will be able to look on some questions from from the past papers. So I don't know whether there is any question before we wind up. Is there any question before we wind up?
The countdown to the countdown. Are you fully prepared, or is doubt starting to creep in? This is your moment. Your moment to refocus, to take charge of your success. Join Focus Online College for our block release program, running from July 21st to August 18th. Whether you're pursuing CPA, ATD, CAMS, CS, or 𝐉𝐎. This intensive revision experience is built for you. Learn from expert tutors. Practice with real past papers. Attend live. Or catch up anytime with recorded sessions. Don't walk into the exam room underprepared. This is your chance to sharpen your skills and build the confidence you need to pass. Call or WhatsApp 0719 445 11 5 or 0116 2200 to secure your spot. Focus on